Okay, welcome back, folks. Did anything exciting happen yesterday? It was quite a day in the marketplace yesterday. Yeah, I've got a few things that I wanted to chat with you guys about today as we get started. A very interesting day yesterday. It's interesting that we love the live Zoom sessions every Monday, Wednesday, and Friday. But it seems lately that Tuesdays and Thursdays, just in the live chat, we're having more action and more activity than we have on our dedicated zero DTE days. But yesterday was an interesting day, and I want to talk about a couple of concepts here as we're getting started today. Hopefully. Some of them we've talked about before, but again, repetition I think is always good. So I had an amazing day yesterday. It was a big day. I mentioned in the chat room yesterday that there are certain days, and it seems like you get two a year. I don't know why that is. I have no mathematical verification or back test on this, but it seems like there's like 2 days a year. Like going back decades and decades for me, it seems like you get one or two shots every year, and random, but just two times a year where you can make a yearly income in one day. Now, granted, my income yesterday, it would not be a great yearly income. You wouldn't be living high on the hog. But there are people living uh, with an annual income on what I was able to bring in yesterday. And so it's interesting on timing wise. We talked about this on Monday, right? That again, that analogy maybe of a poker player where you kind of need to understand, you kind of need to intuitively feel if you have a hot hand or a cold hand. And you need to know when to just simply walk away and say, you know what, I shouldn't be trading anymore. I have certainly had many of those streaks. We have had streaks of those inside of this trading room where you're just like, oh my gosh, everything I touch goes to crap, right? And those are the times where you kind of just need to turn the computer off and walk away for a while. And then there are other moments where you're like, I need to push all in. Like, I need to push all in. And yesterday was a perfect example, at least for me, it was a perfect example of that. We've got some catalysts, we've got some movement. It's very directional in nature. IV is building. We know what the catalyst is. Sometimes we just get choppy markets, right? And stuff's bouncing around. We get volatility. You can't really pinpoint what's driving it. And so it doesn't give you a lot of confidence. Very clear yesterday what was driving that move. We put the news in the chat room. We knew what was the driver. And so it was a good time to kind of push all in. So again, those are opportunities that they don't come very often, right? We'll get in obviously to our positions here, and we'll go through our positions in just a minute. But I just, it's so funny. It's just almost hilarious that Monday I was trying to cash flow my short MES position, right? And my goal is to bring in $200 to $400 a day, $1,000 to $2,000 a week. And it was everything that I could do yesterday or Monday. It was everything that I could do to bring in $80, right? Like that strike price that I used on Monday was very close. Like it was pushing it just to get $80. And we'll look at my hedges here today, but I'm sitting on maybe $6,000 or $7,000 of cash flow for today. What a difference, right? What a difference a day makes. So anyway, I just wanted to talk about that. And when we get into we'll get into the hedges here in just a minute. Well, I'll save that. I'm going to save that conversation. Until we get into the hedges. But one of the conversations that I had with one of you yesterday, as we were really pushing these bearish trades as the market was going down. And we talked a little about symmetry. Now, we talk about symmetry every day in the asymmetric trading system, the model portfolio for long-term buy and hold stuff that I run. And symmetry is just, every day in the marketplace, we never know what the market's going to do, but there's always a little bit of a bias or a directional theory that you can come up with, right? And so that's kind of the question that we were talking about. And you said, how did you know, to push like that on the downside with all of those positions? And we were just talking about symmetry, and you just, every day that the market's getting ready to open up, I think about a couple of things. What is it that's happening in the world today? What's happening in the market today that could drive the market higher? What's happening in the world today? What's happening in the market today that could drive it lower? What's out there that we're looking at? And then how do those balance, right? So if we were to have a discussion right now about what's driving this market higher, and let's be very clear, let's be very, very clear here. We're still in a bull market, right? All of the technicals that we put up today in our market analyses channel, everything, there's some cracks. Some of the moving averages are starting to roll over a little bit, the shorter term ones, but we're still very much in a bull market, right? And so what are the catalysts that would give us a move up? Well, these are the things that I think about, right? We're reopening the economy. So as we reopen the economy, all of the economic indicators, and I mean all of them, all of the economic indicators are earnings per share that we're seeing with companies that are reporting their quarterly earnings, GDP numbers, unemployment numbers, all of these things are improving, right? The big thing probably is just the easy money that keeps flowing from the Fed. That's really what's pushing the market up. But something that a lot of times we don't talk about is housing. Housing is the number one economic driver for individuals in the United States. Now, in other countries, homeownership is not quite as important, but it's still important. But in the United States, homeownership and housing, how the housing market goes is how individuals' personal finances go in this country. And housing, of course, is killing it, right? Housing is the number one wealth store for American citizens. And housing has been great, right? So there's a lot of things that you could say are pushing this market higher. What would push the market lower? Well, it's overvalued. Most every economic or excuse me, whatever technical or fundamental indicator we choose to use, they all imply that the market is overextended or overvalued. But the other things are the worries of inflation and the worries of higher interest rates. And so we've had this happen now. What happened yesterday in the marketplace? We've had this happen 3 times in the last 2.5 months, right? Where the good things, the reopening story, the good economic story, that's pushing the market higher, and it just kind of trudges higher, little by little by little by little. And then inevitably the bad stuff, whether it's inflation or interest rates or what have you, come out and the market tanks. So it comes back to the old analogy that we've heard a million times in the marketplace. The stock market takes the stairs up and the elevator down. We're really seeing that in the marketplace today, right? The market is not at these all-time highs. We're still relatively close to our all-time highs. The market is not pushing up. The S&P is not pushing up 60, 70 points in a day, but it certainly can drop by that, right? So for me, again, you say, well, why are you maybe net short with your hedges? And the reason is just what I've just said here, is that the catalysts up or down, they're more prevalent to the downside right now. The symmetry is very asymmetric, right? And it's asymmetric to the downside. So I just want to mention that, again, it doesn't mean that the market's going down, right? It just says that probabilities are in that direction. And that's what a poker player does. They look at their hand. They don't know what the other people's hands are, but they know what their hand is. And they know what the numbers say, do you push all in or do you just fold? So I do think that now is the time to continue to push to the downside. So I've got a couple other things that I wanted to talk to you about, but let's jump into our trades, and let's look at those first here. And then I think the other conversations that I want to have with you will just develop here. So let's come over to our order screen, and let's go take a look at our positions, and let's go through them. So we've got a few positions open and working right now in the marketplace. The first one probably, let me just go down my list here. So I'll go down in my list that I've got in front of me here rather than in the order here. Our plug trade. So our plug trade, now I wanted to look at this, and you guys give me your feedback on this because I cannot remember on this trade, but I was just looking here before we opened up our activity. Here's my history page. Now, plug. We happen to do this plug trade in my son's account, and I think this has got all of our trades in there. It may not. This is this is going back to April 6th. I believe, someone correct me if I'm wrong in the chat room here. Look at your plug trade history. I think this has got all of our plug trades in here. Now, this seems high to me. It's showing that we're up about $200 overall on the trade, minus about $8 or so of fees and commissions. Someone correct me if that's incorrect. And the reason that I'm saying this, well, a couple things that I want to say on the plug trade. Number one is this was one of our first undefined risk trades that we did. And it was a credit strangle, right? Now, first of all, plug is reporting earnings tomorrow before the market. And so I'm going to let this plug trade play out for a little bit here today, but chances are pretty good that we're probably going to close it down today, let those earnings reports come out, and then come back into it, okay? So we'll look at that later today. Make a note on that. We're going to come back to our plug trade here later today. But the reason, and then the second thing that I wanted to say on the plug trade is, this is why I like undefined risk trades. This is why I like naked trades. This is why I like credit strangles. They're very easy to adjust. This trade never really worked out for us, right? It really needed to be right at about $28 a share to hit maximum profits. And yet again, if my history tab is correct, we've made a lot of money. ROI wise, percentage wise, $200 is not a lot of money, but ROI wise, we've done very, very well with it. And it's because the naked trades, the undefined risk trades, they're easy to adjust. They're easy to adjust. Okay. So I just want to talk about that again, because every time we do an undefined risk trade, guys, I get it. It freaks people out and it's scary for a lot of people. But again, I come back to, and we can use plug here as an example. It doesn't matter what stock it is. I come back to plug and I say, well, you know what, let's just go buy some shares. Well, let's not use plug because we already have a position in there. It's going to mess up my risk graph. Let's use IBM. So let's just say that we come in here and we say, okay, I just want to buy some IBM shares, right? If I were to ask you guys, what is the safest trade that you can do in the market? Well, certainly it's not going to be futures. It's not going to be options. I mean, it probably is just going to be trying to go out and buy good quality blue chip stocks, right? That's what most people would probably say. Well, again, look at the risk graph of buying stock. And again, it doesn't matter if it's IBM or whatever, it's going to look just like this, right? What's the probabilities of being right if you buy stock? Well, statistically, it's 50%. Now, you might persuade me to say, well, I've done some extensive research and technical analyses, and I think I've given myself a little bit of an edge or an advantage here, so that maybe it's 60-40 or whatever. But mathematically, anytime you buy a stock, 50-50 shot, right? Maybe we're right, maybe we're wrong. Max loss on that trade is my whole entire investment. Right? I put $145 into the one share of stock. My risk, $145. So this is what's quote unquote considered the safest way to invest in the marketplace. Go buy good quality stock and hold it, right? If I came to you as your financial advisor and you're like, man, I'm so glad that I found you. We don't know anything about money. You're the financial expert. We're going to hire you to manage our money for us. What are we going to do here? And I'm going to say, okay, I'm going to take your life savings, this $250,000, this $250,000 that you got. We're going to take it all and we're going to put it into an investment that I feel very good about. It's very safe. It's performed well over the long term. It has a 50% chance of working. And there also is a chance that we lose every penny of your money, all $250,000 of your money. How do you feel about that? I mean, most people will be like, I might want to rethink it. But yeah, that's what we all do, right? So the point is, we know that this math is correct. The math is what the math is. But we also know that that's probably not accurate, right? None of us are going to watch our $250,000 account just go all the way to zero. And we do know that there are things that we could do with technical analyses and things like that that can improve our probabilities of success. So again, when we look at a trade and we say, hey, it's undefined risk, it's unlimited risk, it's just like looking at this trade and saying that, what's the max profit on this trade? Unlimited profit, right? Is that real? Well, no, probably not, okay? The IBM is not going to go up forever. So just because the math says that something is a unlimited risk, it doesn't mean that we can't come in and put our risk levels in, okay? So I just want to talk about that briefly there and why I do continue to like Credit Strangles. We've got a channel now just dedicated here to undefined risk trades, and we'll continue to show you more and more of these examples, okay? But we will, again, probably exit our plug trade here sometime today. So make a note of that, okay? So there's our plug trade. All right, the hedging trades. Oh my goodness, what a great day yesterday for these trades. Let's see you know what? So here's what I want to talk about on the hedging trades. Okay. So here's my big position. It's the MES and it's short. And we don't need to go through all of the contract positions here right now, other than just to know that I'm short 21 contracts right now. I've got them covered at 42.35 or no, 41.95. No. There, right there, 41.15. I'm covered at 41.15 on these 21 short contracts. But you can see that I'm obviously bearish in my hedge, right? And if we look at the hedge, again, I've got $2,200 of extrinsic sitting out there and about $800. I've got almost $3,000 that I was able to set up yesterday in cash flow on this. Now, again, just first of all, think about how mind-blowing that is, right? Monday, it was everything that I could do to come up with $80 of cash flow off of that. And now I've come up with you can see there's actually what I did bring in, $3,000 and $1,000. I brought in $4,000 in one day setting up those cash flow positions yesterday. Now, why is that important? Well, I've made videos on that. It's on the YouTube channel. We've talked about that a million times. If we look at my MES position, it shows that I'm down $16,000, right? But if we come in to my history tab, let's go to the history tab on MES. And let's go back to that starting date when we started to build this position of March 9th. Well, you can see I'm actually down about 7,000, right? Well, what's the difference? Why am I down 7,000? Versus 16,000, well, that's the cash flow that's coming in, right? And then if we go balance that against, so down 7,000, and then we look at balancing that, come on, baby, you can do it. We look at balancing that against the ES, and I'm up like 13,000 there. So I'm getting, to a $5,000 or $6,000 overall profit on my hedge. And the point, I guess, that I'm making is not that I'm up $5,000 or $6,000. The point is that I've been perennially wrong in this hedge all the way from March 9th. Tracy, not to be picky, but your wheat trade is listed between MES. I'm not sure what you mean. All I did was pull up MES and ES. We'll get to the wheat trade in a second. We just haven't gotten there yet. The point that I was trying to make was that I'm up 5 or 6 grand on a trade that I have been perennially wrong on since March 9th, right? I want the MES to go down. And what's happened since March 9th? I mean, there's your cost basis right there, right? And it's just done nothing but go up. Okay, now it's starting to curve over here a little bit, so that's good. But here's my point. I started on Wall Street back in 1987, and it was an interesting year to start. It was a baptism by fire, because that was the year that the market crashed. Okay, Black Monday, they called it. And there was a gal working across the street from me in a different building at a company called Shearson Lehman. And her name was Elaine Garzarelli. Now, Elaine was a research analyst. That's a fancy way of saying that you are a water boy. Okay, you're a pencil pusher. You're not a fund manager. You're working. Back then, it was 80 to 90-hour weeks. A lot of times, we would sleep in the office. I mean, there were cots. The movies were correct. We would have cots in our office, and sometimes you would sleep in your office. And so anyway, she was a low-level person, but she had visibility in that she was the media outlet for Shearson for certain items. Okay, so she did research. That's what she did. She had been bearish on the market for quite some time, and she went on Good Morning America the Friday before the Monday market meltdown. Everybody was bullish at this point. She went on the TV show and could not have been more bearish. She absolutely just, and she said the market's ready to crash. The market is going to crash. Okay. Then next Monday it crashed, and she was heralded as an oracle. It was just absolutely amazing to be seen. Now, she had been bearish, like a lot of people. She had been bearish for a long time, but the timing of that was impeccable, right? Shearson rewarded her with her own fund. So she got to open up her own fund, and within a month, she had $700 million under management. So this was, I mean, we all watched this happen. She was a nobody. And all of a sudden she has a $700 million fund that she's managing. Now, that's not a big fund today. That's not an impressive number today. In October 1987, you could count on one hand how many fund managers were managing over $1 billion. That was a big, big deal. And now all of a sudden she's there, and she's, off to the race. It didn't do very well. She didn't do very well. She wasn't a very good stock picker. It didn't work out well for her. Shearson ended up eventually closing her fund and then eventually firing her. But the thing that I thought about, and I've thought about ever since then, was what's the one knock to the bears out there? You go on Twitter, you go on social media, you go on CNBC especially, and you will see these perennial bears that are, it doesn't matter what the market's doing, right? Market's been in a bull market for 10 years, not a single down day, whatever it is, blah, blah, blah. They're bearish, right? Every time you talk to them, the market's ready to crash. And then eventually they're right. And what does everybody say? Well, sure, if you say every single day that the market is going to crash, eventually you will be right. Nobody talks about the 10 years that you were short the market and it just went up, right? And you were wrong. Okay, this is my point with all of this. I believe that, and this is just based on my personal experience, my personal history in the past, I believe that I can guarantee that I will always be right with my hedges. I believe that I can guarantee that I will always be right with my hedges. Now, I can't validate that statement other than what I've seen in my past experiences. And here's why I say that. If you're hedging correctly, you will never run out of money to be able to continue to adjust your position. Now, we've talked about this a million times, but I hope that this idea gets through your head, okay? If you are hedging correctly, you will never run out of the ability to continue to adjust your position. And again, we've talked about this. We adjust our cost basis vertically. It may not be as much as the market adjusts, right? We only may be able to bring in enough cash flow this week to adjust our cost basis maybe 10 points in the S&P, and the S&P went up 20 points, right? So we still didn't catch up, but we always adjust our basis vertically. The market never in its entire history has gone up vertically forever. Markets ebb and flow. And so at some point we'll be able to catch one of those flows or one of those ebbs, right? And that's what we did. That's what we did on Monday, or excuse me, yesterday. So again, just absolute crazy numbers. Something like $17,000 or something on the hedges overall for yesterday's result. But let me just make sure I'm missing some questions. Stanley, assuming that you're long and short, the same equivalent number of long and short contracts in the market inevitably goes against one of the positions sooner or later. The question is, how long do you keep cash flowing those? So it would be, Stanley, it would be a question of technical analyses, right? Right now, you can see what's happening today. Well, we've given a lot of our strength back today here, but we're still bullish right now, and you see the rebound that we had. So we're really in kind of no man's land. If you look at the technical analyses that I put up for you today, there's again, we're sort of neutral right now. If it was to go directly bearish, you see yesterday I had no long positions on. So again, it's just technical analyses, and depending on what the market is, I had no long positions on yesterday, and then I added them back as the market started to rebound. Okay. So anyway, the hedges are doing phenomenal. Now let's look at them here closely. All of the hedges these are my 2 long ES contracts. These all expire today. And right now, none of them are in the money. So I've got another, I brought in almost $1,100 setting that up. Cash flow wise, I've still got $700 of that available there. So we'll see how that develops today, but there's still a lot of profit potential left in that. My MES position, kind of the same deal. Right now, none of them are in the money. 2 days still left with those. Those will obviously expire Friday. Another $1,600, brought in $2,600 on that. Just again, remember on Monday. So Monday, I did everything I could to bring in $80. Now I bring in $2,600 in one day. So again, it just depends on the timing and how the markets are working, but a lot of cash flow still left in that. Okay. So those are the hedges. The wheat trade. So Tracy, let's get into the wheat trade. I've mentioned for a couple of weeks now that I wanted to continue to add to the wheat trade. I'm down almost exactly $4,000 on the wheat trade. And so the premium is so rich on wheat that I don't have any qualms in thinking that I'm going to be able to get that back. But I didn't want to take 3 months to get it back, right? And so I did add to that a little bit. Now we got two wheat trade positions going on here. This is the driver of the whole trade. This is the cornerstone of the trade, is this long-term 710 put. That's not working for us yet because wheat isn't going down. But you can see that it is kind of starting to top right here, right? So hopefully in the next 2 to 3 weeks, we start to see some positive action on this particular position. But this is the profit driver right here. So this one right here is the cornerstone piece, and then this is the profit driver for it. And you can see I've got about $3,000 there total. If you add all these up, about $3,000 of extrinsic value there. I've brought in about 800 of it already, about 2,100 still left out there. That would get me really, really close. Just these positions right here, if they would expire on us untested, that would get me close to getting back to break even. Down about 4,000, that would bring in about 2,900. So good start on the ZW trade. Feel pretty darn good about that. No actions needed there. Our CP, our copper trade. Copper trade continues to work. We're just kind of trying to work towards this May 21st day to extract the rest of the extrinsic value here on this covered position. Again, this was not a big trade, right? The copper trade, like $400 or so is all that I put into that trade. So it's not going to be a dollar trade that makes any of us rich, but ROI wise, it should be really, really impressive. So this was, again, if you remember, it was a leap covered right, or what sometimes we refer to as a poor man's covered call. Okay. So there's our copper trade. Our next one is EWZ. That continues to chug right along. Again, this is an undefined risk trade. This is our credit strangle trade, and really, really, really high potential rate of return on this trade. We've adjusted it once. We pulled the call leg once, and then we added it back in. So that's plugging along okay. Our SPY trade. Let's look at our SPY trade. Oh my goodness. So guys, again, I had two conversations with you individuals yesterday that were along the lines of, oh my gosh, I'm overwhelmed. There's way too many trades. There's way too many channels in here. I don't know where to start. I don't know what to do. And I'm like, dude, just focus on the 4-day expiration SPY trade, or the Q trade, as the case may be, as we go forward here. Man, what incredible potential on this trade. I will tell you that there's a very, very, very good chance that we're going to be out of our SPY trade tomorrow. Okay. On our SPY trade, you can see I put up about $3,800. We brought in, probably after fees, something like $450 net, and we're already at $437. There's only $57 of extrinsic value still left in this trade, and we're bringing in, we're clicking along at about $46 a day of theta erosion. So we could be out of our SPY trade as early as the end of trading today or tomorrow. But I doubt we're going to even need or want to hold this into Friday. So, and I mean, I don't even know what those rates of return are. Let's say that we do 410. We bring in 410 net divided by our 3,800. 10.7%. That's not too shabby for what, 3 or 4 days. So our SPY trade is clicking along pretty darn well. Our YUM trade. Okay, so we need to do something on our plug trade today. We may do something on our YUM trade today. Okay. Now, again, on the YUM trade, don't get caught up too much into your open profit and loss. Okay. If we look at the YUM trade, go to our table here. Get rid of that. Here's our positions. Okay. Here's the problem. Here's why the numbers look all over the map. Bid $1.40, asked $2.20. Bid 50 cents, asked $1.35. Bid 10 cents, asked 50 cents. Bid 5 cents, asked 60 cents. Right. So this thing is either this leg right here. It's either worthless or it's extremely valuable, just depending on whether we're getting a quote that's pulling from the bid or the ask. So we're well positioned here on the Yum trade. There's our Yum trade right now. We're pretty well positioned there, but we may start a very small enhancement to this trade today. And it would be something, I don't know. These are not necessarily the strike prices, but it would be something like this, okay? Where we would maybe add two of those, maybe something like that. If we needed to do a full adjustment on this, it would look something like this. And you can see that it wouldn't add to our buying power, but it would bring in about another $231. Well, bringing in another $231, that's almost what we brought in originally. It's not quite, we brought in 298 originally. It's not quite doubling our profit potential, but it's really close. Okay. Let me answer some questions here. Jimmy, have not done the chicken yet. Phil, have not done the SPX yet. Okay, so we're working our way there. We're getting there. So anyway, probably going to start to slowly add to that Yum trade today. Okay, so we'll probably be working on that today as well. Our VIX trade. So the VIX trade is our wheel trade, guys. We tried to do a wheel. Well, we didn't try. We did. We did a wheel trade a little while ago on gold, and it didn't come down and trigger us in so that we could then start cash flowing it with covered calls, which is fine. We got a decent return on our cash secured put sale, but we're trying it again now with the VIX. And so we'll see if that executes or not. I don't know if it's going to or not. If it doesn't, that's okay too, right? Still a decent rate of return for a couple of days, but this is our wheel trade. So we're looking for the VIX to come down to 38.50, trigger us into 100 shares, then we'll start to cash flow those 100 shares. Okay, so the VIX trade's doing fine, no action needed there. As you know, I closed out the GME trade in the 40 for 40 plan, and I replaced it with the NQ trade. I've now cash flowed that pretty well. I've booked most of the profit on that, and I've cash flowed that quite a bit. That trade. Let's look at history here. Let's go to NQ. Let's go to not March. When did we start this? The 3rd? No. Yeah, it was the 3rd, wasn't it? Yeah, I think it was the 3rd. Okay, so there's my numbers on the NQ trade. Up about 23 grand on that trade in a couple of days. I gotta figure out what to do here at this point. So as you guys know, the 40 for 40 plan was a goal to take $40,000 and see if I could throw every trade in the world at it and double it in a 1-year period of time, 12 months. Could I bring in 40,000 of income off of a $40,000 account? And it was really just a social experiment to just say, hey, it wasn't about trades. It wasn't about the NQ or anything like that. It was about, does the ability really exist to generate a $40,000 a year income off of an account size that is only $40,000, right? And we were going to do that for 12 months. I think I've already met the goal. I think I'm already there. Now I'll have to look at, we got to look at GME, and we got to go back on GME to, well, let's go look at our 40 for 40 channel. When was the first trade? March 22nd. So if we go back to March 22nd, So I've made about $12,000 on GME, and then I've made about, yeah, so I'm up about 35 grand so far. I'm up about $35,000 so far on the $40,000 that I originally started with. So that experiment might be done fairly soon. But anyway, it's been fun to do. I'm going to probably continue to cash flow this. Now, one of the things that we'll get into it a little bit later here today. We're getting long in the tooth here, and so we want to get started on our zero date expiration pretty quickly. But I may adjust my shorts here on my ES today to try to maximize a little bit more income out of that. I may adjust my shorts on my MES as well to bring in a little bit more income. So I'm looking at potentially somewhere between $600 and $1,000 of additional income potential today, just on those. I might do the same on my NQs. Okay, I'm short. I covered this at 13,530. We're at 13,600 now. So I might be able. There's still $1,200 of income left in this open position. I might still come back and hit that again today as well. Okay. So we went through the YUM trade, the VIX trade, the NQ trade, lift. Oh my gosh. Knock on wood. We are absolutely killing it. We are absolutely killing it on these earnings trades, these volatility crush trades. And by killing it, what I mean is, look, we all know that the volatility is high because there's earnings coming out. We know the volatility is going to crush. The hard part of this is calculating what the potential move is going to be, right? And we're a half dozen of these volatility crush trades in now on doing these, and pretty much every single implied move that I have told you guys to expect, that's exactly what we got. And lift was the same. We're going to close this down here today. We're going to go ahead and book this and just book our profit on it. One-day trade, quick one-day trade. Stan, how about adding the put, MVIS, how about adding the put side back in? It was looking at the May, we can look at that. We can certainly look at that. We closed that one down at a very, very minimal profit because of price action. We can look at that again for sure, okay? So lift, we're gonna close that one out. So we're gonna do something on plug. We're gonna do something on YUM. We're gonna close our lift trade probably today. And then correct me if I'm wrong, guys, but I think this is our last position that we're in is the SP. Oh, no, excuse me. Yeah. So we've got multiple SPX trades going on. Okay. Now these kind of, I don't know what that is. Fuchsia, pink. I guess those are pink. Disregard those. Those are in my son's account. But we've got multiple SPX things going on right now that, ideally I would like to close down here before we get our zero date expiration for today going on, just so that there's not a lot of confusion going on. But if you got into those, Jimmy, it looks like you got in on a couple of those. Let's take a look at those real quickly here. So let's see if we can isolate these. We put on a pretty big iron condor. At least it was big for me. It was about... I think of the $39,000 that I have committed right here, it was maybe $33,000 of that. So, pretty substantial iron condor. And these are the positions right here. Now, I didn't, on the put side, you can see right here, I've got if I get rid, I know it's hard to see. I know this is not easy to follow, but right here's the call leg of the iron condor that we put on last night. And Insomniac, you booked $1,000 on it already. Fantastic. There's the call leg, 4205 by 4215, 32 contracts. And then on the put side, I've got two different strike prices. I could only get 5 of the 32 filled down here. And so I needed to move it up and do the remaining 27 up here. But that short leg is at 40.50. Okay. Now there's still some extrinsic value left in that, but not too much. I brought in $3,000 almost on that overall with everything here. and up about 2,500 bucks. So probably going to close this out and book the profit on this before we do our 0 day to expiration today. Okay. But the one that I just forgot was our overnight chicken. Okay. So let me talk about that for just a second. I put a video up. They call them a chicken iron condor on Tastyworks, and I did put a video up earlier. That's I think Stan or somebody had asked for a definition of that, and let's look at that, because that might be Jimmy. I think Jimmy, you did it, and I think you already maybe closed it out. It's and then again, there's a lot of stuff going on in here. I want to make sure that I get the right strike prices. That is it, I believe. You know what we can do? We can go in here to my activity. Let's just look at activity here. And there it is right there. So there's the strikes that I'm looking at right there. Put this on at about 6 o'clock at night, last night, my time, mountain time. And it's called a chicken iron condor, okay? Okay, you got to chart to show. Yeah, we're going to go to the chart here just a second. So I had two of you last night, and again, I understand because it's sort of a new approach. I have two of you that asked me said last night, I don't want to do that because the probabilities of that are really, really low. So let's pull this up. You can see right here, I sold it for a $10 credit, right? So let's go to that. Yeah, I think this is the one I want to show you. So let's go to the curve and let's just put that one in. Should be correct. Yes. Okay. Now I don't remember what the probabilities of this last night were, but they were, I think, worse. I think they were worse. Let me pull that out. I don't know why that's. They were worse than this. There's maybe 39%, Joey. Okay. So I have two of you say, I don't want to do that trade because it's such a low probability trade. And we're just, with iron condors, we're so used to looking for 70, 80, 85, 90% probability of success trades. And my point back was, it's a low probability of success trade by design. It's a low probability of success trade by design. And if you look at the Tastyworks video tutorial that I just put in a little bit higher here, it talks about basically just the idea of trying, generally speaking, when we look at a spread, we're trying to collect 1/3 the spread size. In this case, we're trying to collect half of the spread size or more. Okay. Now the spread was $15 on this trade. The spread was $15. I collected $10 of income. Okay. I was risking there was about $400 of profit potential in this if it hits perfectly. I was just trying to make 200, and I was going to risk 100 to do that. Okay. Think about, and we were way out of this box earlier. We should have shown this earlier, but we were way out of this box, and I was down $40. I was down $40. It was a $200 or $300 trade, basically. What did I put in it? $229, something like that. Okay. So yeah, that's a good trade. I'm probably going to book the profit on that as well, Joey. Another nice trade. So our ES trade, we'll be booking the profit on that as well today. So it's going to be a busy day here this morning. We're going to get into our 0 day right away as well. But man, what an awesome day yesterday. Just what an amazing day. And again, it comes down to the hedges. The hedges are the gift that just keeps on giving, just pouring money in every single day. And it should be just another beautiful day for those. We'll get started here, guys. I'm going to get started looking at the plug trade, the yum trade, the lift trade, and exiting the overnight ES trade. And then we'll get into our 0 day to expiration. Okay. Stanley, what made you decide to take the trade as opposed to something else at the time? Just risk reward ratios. It was just a really, really solid risk reward ratio trade. Again, it kind of comes back to the most extreme example that we have of this. And the most extreme example that we have of this is our iron, it's not our iron butterfly, it's just a normal butterfly, right? We're doing those trades at 20% probability of success. And yet, do any of us ever worry about them not working? Do you ever do one of those and go, oh my gosh, I'm just freaking out. I don't know if this is going to work. That's when you know you build a good trade. Because yes, Tom, I need to close that too. We're going to close the SPX trade too. I'm going to book the profit on that. So let me get going on these guys, and then we'll keep moving on. Tracy, did we cover the because why not IC in MES? Yeah, it's just maximizing my delta. It's just when it's such a hard concept, right? If it's a hard concept for the uninitiated, it's a hard concept for the initiated. You look at my ES position, and this is all kind of fluff right here, right? Like this is just cash flowing stuff, but the essence is I'm long 2 contracts. You look at my MES position, and again, this is I'm just kind of trading around it here. This is just kind of fluff, but the essence here is I'm short 21 contracts. And you're like, well, wait a minute. These are 10-to-1 ratio positions. You're long 2 ES, you're short 21 MES. That position totally offsets. It doesn't do anything. Well, you're right. It doesn't. It offsets, but it allows me to cash flow each side. And again, a couple of you had put up a few days ago, well, you don't need to do all this. You don't need to buy all these futures. You could just do a credit strangle with the options. Remember options? Now you're dealing with all that stuff. You're dealing with deltas that are not 1-to-1. You're dealing with expiration dates. You're dealing with theta. It's a lot cleaner to do it with these. Okay, I think unless we've got more questions coming in, we need to get started. We need to get cranking for the day. So let me get some of these trades moving here, and we'll be back in just a second. Okay, quick note, guys. I did just close out the plug trade, and that makes more sense now. Closing out that plug trade now, looking at it in my history tab, you can see that I am down about $100 now. So we'll come back at this after tomorrow and reattack plug after the earnings come out. But I'm going to put that in the trade tab right now, and then I'll keep moving on with the other trade. Okay, bounce back over here real quickly. I just closed the chicken iron condor from last night. We got in at a $10 credit and got back out at $8.50. So a nice little scalp, nice little profit there on that. And I'll go ahead and put that in the trade tab. Okay, quick comment here on our, I guess you could call it a 2-day to expiration SPY trade, SPX trade. I am going to probably leave this for just a little bit longer here today. It may cause some confusion when we put our 0 date expiration on for today, but you can see that this is, well, let's look at it in a risk graph. That's where we're at right now. That's where we're at in that trade right now. And I am the obviously we're closest to the call legs. The short leg is 42.05. We're at 41.75 now. So 30 points away, and I'm up about $1,800 on it with about $400 of extrinsic value. Okay. So I would like to give this a little bit more time. You see, it's starting to work itself away here. So, if I could get this down under $200 of extrinsic value, something to where I was close to $2,000 of profit here, I would go ahead and book that. So I'm gonna let our overnight SPX trade continue to work a little bit. Okay. So I'm going to let that one run. Got the ES trade done. I'm going to exit the lift trade, and I'm going to book our profit on that. I'm going to take the profit on that and run. Let's get out of this. NAT is 10 cents, and I'm trying to get 7 cents. So we'll see how close we get. It says mid price is now, well, it's still showing a mid of 7. Let's see if we can get 8. Go to 9. Not yet. NAT price is now at 10. So I should certainly be able to get 10. Cost me 20 bucks to get out of it. So there we go. Booking a nice profit, nice one-day profit, nice over just about what, 4%, something like that, 4% profit overnight. That's not too shabby, guys. It's not too shabby. Okay. Get this one put into the trade tab as well. We're getting there. We created a lot of activity yesterday. This is also obviously freeing up a little bit of cash for us here today. If you're like me and you need it because you went hog wild yesterday, right? So getting the lift, we got lift cleared out now. I'm going to work on the Yum trade here, and then I think we'll be ready to hit the 0-date expiration. Sorry, guys, trying to multitask here. And I've missed a couple of questions that have come in here. Hanker, I see you originally got into the ES and the MES position as hedges. Could one put on an ES MES offsetting position just with the intention of profiting on the cash flows on both sides? When one gets called away, you'd close the other one, too, and start over. Yeah, you can. In my largest account, in my largest trading account that I have, I only ever have one trade in there, and it is doing not exactly that, but essentially that, going long and covering, or going short and covering, just basically cash flowing the markets, which is what you're talking about. Okay, Tom, what's the possibility of doing a 0 DT on something other than the SPX and letting the existing one burn off more extrinsic? I know. It really is the best option. The SPX really is the best option here to do. we could potentially look at the NASDAQ, but then we don't have a zero DTE going on. So, um, yeah, I mean, I hear you, you know, I've got the same situation here. If I'm on my, let me show you my screen, you know, I still got 500 bucks of extrinsic sitting out there. So, the thing is that, you know, it really, all we're really doing is repositioning. Okay. And here's how I would look at it. Instead of saying that, oh, you know, I'm going to close this down and throw away $500 um, of income, look at how that uh, iron condor, if you will. I mean, it is an iron condor, but we got two different legs going down here on the put side, right? Um, but look at that. Look at where the market's at, and look at where our profit and loss zones are at, and say, uh, would you go set up this trade right now as it's currently constituted? And for me, the answer is no, right? It's way too close to the call leg. So don't look at it as though we're giving away $500 of extrinsic value that's still out there. Look at it as though we're booking a really, really solid profit right now, and then we're going to come in and reposition this a little bit more equidistant. That's what I think we need to do here. So I'm gonna go do that. I think next I'm going to close this down and put that into the trade channel, and then we'll be able to. I mean, my goodness, Tom, I don't know how much money. Tom, I know you throw around. I know you're a whale. I know you're throwing around some big bucks. But you know, that was a pretty big iron condor for me. 32 grand, and to bring in $1,600 overnight. Come on, you got to be happy with that, right? So I think that I will book the profits on this, and then we'll reposition. So I'm going to work on that right now. Okay, I booked my profit on that iron condor. My fills here, I'll put these into the trade tab, but you can see it's kind of messy just because I did have those two different put legs involved in the transaction. So I had to do two separate exit orders there to get out of those. But I don't know that all of you were in the same strike prices. Like I said, I only got a few executions at that first strike price. So let me get that one in. Yeah, a lot of activity yesterday. Oh my gosh. Okay, Getting close here, guys. We're getting close. I'm gonna watch the market. Interesting. We've come right back, right? Kind of dropped off there and right back to where we opened at. So let me see if we got anything else that we need to clear out, and then we'll get started. Hey guys, quick note here. I'm going to come back over to my order screen. You know what? There is no reason to continue to sit in our 4 DTE SPY trade. We're good. I mean, brought in $494 gross. That's probably what, like 470 or something in net, and we're there. I mean, there's $19 of extrinsic value still sitting in it. I would rather have my $3,800 back. So I'm going to go ahead and book our profit on our SPY trade right now. Call that a day. And man, this might be one of the quickest exits at the biggest. This is probably the quickest exit at the biggest profit that we have had on our 4 data expiration trade. But I am going to close this. Now price is 4, and that's probably what I've got to pay. I do get out of 4. So I'm going to get that recorded as well. Okay, I got the SPY trade exit locked in, booked our profits there, and now on to the YUM trade, and then finally on to the 0 DTE trade. Okay, so we're going to work on the YUM trade now, just a little bit. This is just a teeny tiny enhancement to the trade, which means that we may come back and do some more if necessary, but just a teeny tiny enhancement. So you can see the structure that we have right now, very, very biased to the downside, and there's an incentive there built into the trade for us to get down below 107.50, right? That's it doesn't quite double our profit, but it really gets close to that. And obviously, we're much now closer to the call leg than the put leg, which, by the way, if you have been in the crash speculator over the years, you kind of know this is how these trades work. This is not necessarily something to either be alarmed with or to be surprised at, but nevertheless, very close, right? So we want to try to enhance this a little bit. And we're going to do that. There's always a trade-off, right? When you build a trade that becomes safer, you're going to have to give up something. And what we're going to give up is this extra kicker down here on the bottom. So I'm going to come in on my Yum trade. First of all, you can see again, I'm using 7 contracts on the call side. So I've got a little bit of room here to work with on the downside. And what I'm going to do, I'm going to put it in at the 115 and the 113 strike price. I'm going to go back to the curve now, and you can see what that does right there, right? By selling that put credit spread starts to drop my profit there. I'm going to do one more contract. There's 2. And you can see with 2 now, so again, you'd have to look at the ratios that are appropriate for your position sizing. I don't know what that ratio is, but well, it'd be a 2 to 7 ratio, however you want to break that down, 2 to 7 ratio. But you can see that what it does there on the downside is, technically speaking, if you look at my numbers there, at expiration, it does show me with a $56 loss, but the profit and loss that is on the theoretical line still leaves me in the profit zone, right? So as long as we could manage that before expiration, I'd still be in the profit zone there. We're just knocking the profit down. We're just knocking the profit down, okay? But what we are doing is bringing in another $44 of income on the trade. So if you remember the trade, we brought in, probably what, $270 after fees. And now we're going to bring in another $60. So it's just kind of enhancing the trade a little bit. Okay. If we needed to, we can come back and add those remaining contracts in. Now we're bringing in $200 of income and basically creating an iron condor out of the trade. And not quite, but almost doubling our income potential. But for today, we're just going to do a 2 to 7 ratio. Okay. So I'm going to try to get this filled at 25 cents. It does fill at 29 cents. So much better fill than I had thought I would get on that. I'm going to go ahead and get that into the trade tab. All right, guys. This is, I'm going to tell you, this is a little bit later in the day than I had hoped to be at before we got started on our zero date expirations day. But it's actually been beneficial to us. Look at that big swing back in the marketplace, back up to the opening of the day. I'm going to take a quick little break, grab a glass of orange juice and something to eat, and come back maybe 9 minutes at the bottom of the hour here, and we'll see if this trend continues here and where we go with our zero DTE for today. Okay, guys, I think finally 2 hours into the day, we are cleaned up with all of our trades. Now, my ES hedge, my MES hedge, and my NQ trade that I am doing inside the 40 for 40 plan. All three of those I have cash flowed right now, and I may come in and alter those here today if the market keeps going higher. So I might have an adjustment there. But I do see a question here from Helder. Can you explain it in further detail? I want to understand the why of it. So every trade needs to have a trigger of some kind, Hilder, and hedges are no different. And that just happens to be the trigger. The trigger for that particular hedge is that the S&P 500 is down below the 10-day moving average, and that it's closed down below it. That it's actually not just that it's penetrated below or is currently down below, but it is closing down below that. So unless we get a pretty decent sell-off today, I don't think we're going to get that trigger. But every trade has to have a trigger. And that happens to be the trigger to that particular strategy. So I'm still waiting here, guys, at this level right here. Just want to make sure I'm on. Yep, I'm showing you guys the chart. So we're just kind of waiting here. We're back at the opening price, and we're powering higher. And so the question is, do we continue to power higher? So I'm going to give it a few more minutes and see where we go here. This will obviously determine what I do on the covers for my hedges and my NQ position, but also where we enter on our 0 day to expiration. Yeah, I'm not having. I'm seeing you guys your comments in here. I'm not having this all of the same issues that you guys are having in Tastyworks, but like my cap requirements have disappeared. I got to go up to the wheel to find those. So I don't know what's happening inside there, but anyway, we'll continue to just be patient here for just a little bit, see where the market goes, and see if we can, obviously right now, the strong leg to enter would be the put leg. But I think that we might kind of get some capping out here, some resistance here, which might give us a little bit better premium on the call leg. But we can't enter the call leg right now, so we're going to wait for just a little bit. Yando Scott, you closed your overnight SPS scalp. Did you also close? So the scalp or the chicken iron condor was on the ES. And we also closed our iron condor on the SPX. So both of those should be in the trade tab if you look in there. We closed them all. Yes, Helder, we went over everything. Everything looks lovely. Yeah. Okay, guys, we're continuing to power higher here, so we're gonna let the market do its thing here for a little bit before we get our position in. I did want to just talk about one thing real briefly here while we're letting the market push up right now. I mentioned in the research tab this morning, the news tab, Wednesday, obviously, and 8:30 a.m. Mountain Time, my time, on Wednesdays. We get the oil inventory numbers out, and we haven't gotten into the oil trades yet. Number one, I want to get you sort of the same owner's operating manual. I want to get you the same training manual that I got for you on the volatility crush trades. I want to get that same kind of education to you first on the oil trades. But this is something that we're gonna add this into our portfolio here of different things that we can look at and do. And it's always nice, one of the things we've talked about this. One of the things that I like about earnings trades is you can plan on them, right? Like you can say, hey, next Thursday, I know I've got a trade for ABC stock, right? Because you know when those earnings announcements are going to come out. And that's one of the things that I always like about the oil trade is that, every Wednesday that those numbers are going to come out, right? And so oil inventory numbers, right? Let's see, right there. That's where they came out right there. So this is very, very typical. This is what you see. Very little movement before the oil inventory numbers come out. The oil inventory numbers come out. A little bit bigger supply than expected. You get this initial sell. So this is the first wave that you usually will find. It usually comes in waves. So let's say like today we get oil inventory numbers a little bit bigger than expected. So, more supply than demand. And so you get that initial sell off right here. And then, so you're trying to do a 1-2 punch with this trade. You're trying to catch the initial move. And then what is almost always followed, not always, but generally followed by a little bit of a rebound. So in this case, we get, more supply than we thought. We get the sell off. You want to ride that sell off, and then you want to ride the rebound. Okay. What happens afterwards starts to get a little fuzzy. Vice versa. Let's say that we get oil inventory numbers lower supply than expected. It pops up. We want to ride that trend up, and then we want to ride it back down. So it's sort of a 1-2 punch trade, but that's kind of what we'll be getting into. And Greg, yes, we're working on the scalping trade, right? We're working on the scalping too. So these are probably the next two in line: oil trades and the scalping trades. Okay, market's still pushing, guys. We're gonna let it push here for a little bit before we get in. Hey, so a couple quick things here, guys. The market's still pushing higher. We're going to let that keep pushing here until before we do our 0-date expiration and try to see if we can get some resistance levels put up here on the top level. But I got a little bit of a bonus trade that I want to look at here. So PTON, Peloton. Let's look at the chart of this thing. Pull this down a little bit. Let me get this straightened out here a little bit. Let's go to a daily chart. There's your 5-minute chart of it. Here's our daily chart. Peloton recalling treadmills after not only are people getting hurt on them, but now apparently there are deaths that are being reported. So they are recalling all treadmills. So we're just going to take advantage of this weakness here. They are reporting on May 6th after the bell, tomorrow after the bell. And so we're going to try to take advantage of a little bit of this weakness here and go sell these 97 strike price calls. Well, I'm going to look at this spread right here. We'll see if this works. Maybe $1,000. I'm going to put maybe $1,000 there. 86% probability of success. It's outside the expected range. It'd be about $140 coming in on about $1,000 income. We'll see if I can get executed at the 26 cents. I don't know if I'll get that or not. I think I'm close. Nat price is all the way down at 13 cents. So we'll see what I get fill-wise here. I'd like it to be better than a 10% potential rate of return. So we'll keep working this here. It's a little concerning that Nat price is all the way down at 13 cents. That'd be $120 right there, income on about $1,000. So I'm still above the 10 cent mark, or excuse me, the 10% mark here. Keep coming down here. This would be $106. So now I'm getting right. There we go. I get a fill at 21 cents. So better than a 10% implied rate of return potential on that trade. So I am going to put that into the trade tab here. If I can get, here we go. Yeah, not good. Now, they're reporting earnings, which I did, the earnings are going to be blowout earnings, right? The earnings are going to be great. But when people are dying using your treadmill, that's not good for your corporation. Just watching the market here as well. Just keeps pushing. We'll let it keep pushing here. Okay, so I got the Peloton trade in, and again, we'll as long as the market keeps pushing here, we're going to let it do what it's going to do. Okay, before we get our puts, our 0 DTE positions started. as the market keeps pushing here, I am going to come in and I'm going to adjust my covered position here. First of all, on my MES position. Now, if I look at my ES position first, okay, I'm up about $1,900 on my ES position. Got about $300 still of extrinsic value there. So it could be a $2,100 day there. And I think I'm going to leave that. I'm going to stand pat on those for right now. Two long contracts. One is covered at 41.75, which is about where we're at. And one is covered at 41.70, which is about 9 points, 8 points lower than where we're at. I think for right now, just because I got $350 of extrinsic still sitting in there, I'm just going to let that ride for right now. But I am going to adjust my MES positions. Now, my put leg, my put spread that is down here at 40.50, that's fine. My call spread that's up here at 41.95, I don't know how close that is. We'll see in the next day or so. We've got 2 days obviously left to expire on that, but a lot of extrinsic value still left in that. Obviously, I'd like to let a little bit more time burn there. Here's the one I'm looking at. I've covered my short 21 contracts here at 41.15. There is about $350 of extrinsic value still sitting in those. But with the market moving up the way it is, I think I'm going to roll that up. Now, I'll show you what the trade looks like, but remember, at least in Tastyworks, you can't actually roll these. You have to close it when we're talking about futures. You have to close it and then open up the new one. But I can show it to you what it would look like. Okay, so there's the leg right there, the 41.15s, short 21 of them. And I could probably roll that up to something like 41.50 and bring in another 250 bucks. That's not too bad. Again, remember, I'm trying to bring in $200 to $400 a day, $1,000 to $2,000 a week on these hedges to get to that position where I feel like I can never be wrong, right? Eventually the market will go down, right? It always has. And the only real thing is, do you have the staying power to be able to be in that trade still and benefit from it when it happens? The only way you have that staying power is to generate enough income to keep cash flowing these things going forward. So I think I am going to do this trade right here. Again, I can't actually do that roll. You try to do that roll. Well, on the options, I get options you can, right? Options you can. That's my bad. Options you can roll. It's just the actual futures contracts that you can't roll. So let me see if I can get a fill on this. Maybe an extra $250 in income, something like that. And then I may need to do something along those lines with my long ES positions. Filled at 280 on that. So, again, we talk about cash flowing these hedges, and this is it, guys. This is it. Just trying to bring in enough income on a daily and weekly basis so that if the directional move, I'm going to put this in the hedge channel, trying to bring in enough income on a daily basis so that if the hedge or the directional move is not what you want, you're still okay. Market's still going up as I watch this. We'll see. We'll give it a little bit more time here to stretch its legs. Okay, back to the chart. And we'll watch it here and again, see if we can find an area where we can get some resistance going. Russ, I can't remember. I'm pretty sure it was you, Russ. I'm not sure, but I think it was you on a previous trade, just exactly like this that we did, where you had the same question. So let me see if I can address some of the things that you said. So DOS answered you back first of all, and this is maybe not answering your question in the correct order of what needs to be addressed, but this is, I think, an important point. And I guess the overall point is, Russ, you have to look at the whole trade. You've got to stop isolating certain segments of a trade. And the most egregious example of this is a spread trade, right? Where we have a short leg and a long leg. We are guaranteed 100% of the time that one of those legs will lose money. 100% of the time. You're entering a trade with two components of which 100% of the time one of those legs will lose money, right? That's not a negative. That's how that trade is designed. And you get that if you look at the spread as a whole rather than individual trades. So what you're doing here is you're looking at one aspect of the trade. It's never going to give you good math. DAS's point was it's an 85%